Hey everyone, it's Kevin and thanks for joining. Have you ever opened a stock page like this and been totally confused and lost and not know how to get started? Well, this happened to my friend recently where she went online, looked for advice, and saw all these people looking at random charts, drawing crazy trend lines, and pushing the next viral stock. Then she came to me and asked for kind of the fundamentals of how I got started in stock investing. In this video, I'll go over the foundation and the 6 basic metrics that I think every beginner should know when starting with fundamental investing in the stock market. Please like and subscribe if you like videos like this, and let's get right into it. So I've pulled up 6 metrics that I think every beginning investor should familiarize themselves with as they're learning how to evaluate a company. I'll read these off quickly and then we'll dive back into the webpage and show how I use them in practice. Starting off, I look at earnings, and that starts with earnings per share, or EPS, and that's just generally the net income divided by the outstanding shares. It indicates the profitability of the company. Higher is better, and you generally want to see this growing over time, and you want to watch out for trends. Next is price to earning ratio, and that's the stock price divided by the earnings per share. That defines the stock, whether it's cheap or expensive. Generally, lower is better, and you want to compare this against its historical average or the market average. Next, we have return on equity, and that's ROE, and that's the net income divided by the shareholders' equity. It's an analog to management effectiveness. It also tells you how well the company is deploying its capital and getting a return on that capital. So higher is better, and generally you want higher than 15%, and that should be easy for most companies. Next is gross margin, and that's the gross profit divided by overall revenue. This indicates the overall pricing power, or moat, that that company has. Higher is better, and it indicates the overall protection it has from competitors. Next is debt to equity, or DE ratio, and that's the total debt divided by the total equity. This indicates how much debt or leverage the company has taken on. Lower is better, and you want a company with very little leverage if possible. And lastly, you have current ratio, and that indicates, or that is the current assets divided by the current liabilities. And it basically tells you, does the company have enough cash on hand to pay off its current bills? The higher the better, and a ratio of 1.5 means they have a very comfortable cash cushion. So reading us off is pretty easy, but let's deep dive into a stock and see how we use this to evaluate a company. Okay, so I've pulled up Nvidia here. I thought it'd be a good example to use because it's very popular and we want to come to a consensus. Is this a company with good value going forward, or is it too risky to invest in? Let's take a look. So you open up with this page and there's a lot of information here. It is useful, but I think for beginners it can be quite overwhelming. I'm not going to go into deep detail into this. Some of this information I pay attention to is like EPS and PE, as I've said. Beta is an interesting one because it gives an indication of volatility. Here, like volume, again, those are relative to technical analysis and momentum traders. But what we want to get started with is how to evaluate this company. As I said, I look at earnings first, and then I look at gross margin and fundamental information like safety and debt load. So let's start looking at Nvidia's earnings. And what we want to see here, this is really an ideal image, right? So you're constantly seeing, so this is EPS, right? And as I said, we want to see a trend. And what trend do we see here is continual EPS expansion, or earnings per share expansion, consistent growth and strong revenues. The green arrows in this instance indicates a beat to the consensus estimate. That means Nvidia outperformed what analysts believe it was going to earn per share. So this EPS is a good indicator of earnings, and watching that trend over time indicating a positive slope, meaning continual earnings expansion. So that's obviously great for this company, and if it can really achieve this, that's honestly amazing. Now, when we look at EPS, that has a direct impact to PE ratio because the earnings per share relates to earnings. And if you remember PE ratio, it is price to earnings. So if you have constant earnings growth, the PE ratio would naturally compress. And so that's what we're looking at here. So over time, historically, the average PE ratio in 2023 for Nvidia was trading at around 51. Then in 2024, 48, and so on and so on. And you see PE ratio compression, which is great. Normally, the PE ratio may float back up to the industry average, indicating that if you were to get the stock or Nvidia at this lower PE, that means you found a lot of value at the time of purchasing. One thing you might want to pay attention to if we look at this, some similar chart down here, is something called TTM, and that stands for trailing 12 month. And you'll see that attached to a lot of different metrics. And that just indicates what has the prior 12-month average been at. So it gives you an idea of its historical average so you can compare it to today's number. The trailing 12-month PE ratio for Nvidia right now sits at 31.9. Relative to the industry average, you have a few that's dragging them down, right? You look at Micron and you look at Qualcomm and Intel, those are significantly lower in terms of PE ratio relative to Nvidia. However, you look at Broadcom and AMD, those are very high PE ratios relative to Nvidia. So I would say Nvidia is relative to its peers, maybe a little bit higher given Micron and Qualcomm and Intel in this case. But it's very hard to tell from just the PE alone whether this company is priced fairly or not. I would need to know what is the industry, the overall S&P 500 PE ratio average to know whether this is a cheap or fairly priced stock. But very strong earnings growth, very nice EPS. So let's continue to look at fundamentals to see whether this is a strong buy, or a hold. So if you recall, I look at GM or gross margin. In this instance, it's gross profit margin. And here it's nicely displayed for us what the industry average is. And Nvidia is doing much better than that, right? So they have a gross margin of 71.7%. And that is really good, right? That indicates that they have a strong position over their competitors. Their competitors have not pressed them on their margin yet, and they're making a lot of money per product or service that they're providing. That is reflected in overall profit margin relative to the industry average. So GM is a nice number that I like to look at, and how well they have pricing power over their competitors. Next, we look at ROE, right? Return on equity, and how effective is Nvidia able to deploy its available resources and get a return on that investment, right? So the industry average is 48.94%, and they're doing much better than the industry average at 101.49%. Meaning they're getting a lot of value or a lot of return on the internal capital that they're investing on. So really good management effectiveness, really good sign that Nvidia is deploying its capital well. Then we look at the financial strength of the company again, right? So those metrics that I told you kind of let you get a preview or get a deep understanding of all the basic high-level numbers. Here we look at current ratio. Remember its ability to cover its bills within a 12-month span. Here you have 3.9, which is very high relative to an industry average of 2.8, meaning they could pay their bills over 3 to 4 times over. This could be a good thing and a bad thing, right? So 3.9 is great. They have a huge cash reserve, but I would question why they have such a huge cash reserve for a company with continual EPS expansion. are they using their cash on hand very well, especially when they get such a good return on equity? So why are they sitting on so much cash? That's also reflected on their overall debt load. It's not very high. So remember, DE ratio was the next thing that I look at, right? The industry average is at 26.93, and they're much lower than the industry average. So they're sitting on a lot of cash, do not have a lot of debt, and they're getting a lot of good return on the cash investments that they do make. That's all healthy signs of a very good growing company. So again, if we looked at EPS and we looked at the PE over again, from what I see so far, it looks like Nvidia is a very strong buy, and it looks like it has room to expand on its PE ratio. So 32.44 is where the PE ratio is today. The trailing 12-month PE ratio is at 31.44. So it's actually a little bit higher than its historical average. But if you look at its EPS, its cash position, its overall debt, and return on equity, they're all very strong positions. To me, I would be very favorable in thinking that there is room for the PE ratio to go up over time. And so I hope that really helps you understand kind of the basics, and that gives you a little bit of overview of kind of the fundamentals look. And let's look at the overall, what analysts say. So analysts, I would say, agree with the overall fundamental analysis that we just did, right? With all three strong buys with a price target of 350. So they're obviously expecting some PE expansion as well. I hope this really helps demystify some of the information here, but let's look at a company that may not be so popular and see how does that look like, and if that makes any sense or relative to the fundamentals that we look at. So here I know IBM just reported, and they had an awful day of performance. So let's see how that looked like. So again, when I look at these numbers, I focus in on EPS PE ratio. I look at beta, surprisingly. I'm not going to go too deep into that, but that does give you an indication of the overall volatility. But let's focus in again on EPS and PE ratio. And to do that, let's deep dive into IBM's earnings. So we look at IBM, and the first indication that I can see is very variable EPS performance, right? So very hard to predict whether this company is beating on some earnings estimates or in other estimates missing on their overall EPS, right? Or earnings per share. Very volatile, so I don't really like to see something like this. If I were to invest in a company like this, I would expect them to have a larger cash reserve and lower debt load to be resilient to this level of EPS performance. So we'll check on that if that's the case. If not, I would be a little nervous about the overall valuation of this company if they're not managing their cash and debt load well when you have such variable EPS. Let's look at their overall PE ratio. So that's shown right here. So it looks like their TTM PE ratio sits at around 21.43. And if we remember the first page, I think it was at around the PE ratio today sits at 19. So definitely the EPS for Q2 2026 definitely dragged down the stock, and people are not liking what they saw or heard on earnings. Historically in 2023, it's performed around at a PE of 20.1, jumping all the way up to 34, 26, and it relatively goes back down. So I would say in 2024, it was kind of expensive. Even at 2025, a 26.5 PE ratio seems a little expensive for IBM. Again, if you look at its industry average, its industry peers, and its historical TTM for PE ratio, Anything higher than 21 seems relatively high, I would say, meaning kind of expensive for this type of stock in this industry, right? IBM selling quantum and mainframes. It seems relatively expensive to its peers, and that's reflected here, like in HP, Ingram, again, HP Enterprises, things like that. So kind of so far not too exciting about IPM, and I can see why people pulled back on it to bring back that PE back into a more fair range for its price. Let's dive into the fundamentals really quickly. Again, we look at gross margin, return on equity, debt to equity, and current ratio. So their gross margin is okay. Their industry average is at 45. It's not like 70% like Nvidia, but they still have pricing power over the industry average. So they may be the leader in this industry. And that's why they had a gross profit margin better than their industry average, better than the industry average, or better than their peers. So that's relatively healthy. It looks good. They're probably best in class for whatever they're selling. And then we look at, return on equity. This looks not bad relative to the industry average, 35.26%. So they're deploying their available capital pretty well. Doesn't look anything too amazing, but still pretty good. So these two look healthy. So in that instance, I would have expected the PE ratio to stay around 21. But let's look at its financial strength and where do we see? Okay, so this stands out quite interesting. So the industry average is at 2 and they're only at 0.9. And if you remember me mentioning back in the PowerPoint slide, I don't like to see a stock or a CR lower than 1.5 unless it can be justified by its return on equity or its strong EPS, right? For a company like IBM that has very volatile EPS, I don't like to see a company with this little cash and double that with this level of debt that they've taken on. So the industry average here, or DE ratio here for the industry average, is 123.61%, and they're even higher than the industry average at 175% debt to equity. That is quite high. I really don't like that. So I really don't like the current ratio or the debt load that IBM has taken on. Couple that with, if we go back to earnings, couple that with its EPS miss, its earnings per share miss for this quarter, and it's very volatile, predictable earnings. It does not look like there is a lot of value right now in IBM, right? And how did I come to that conclusion? I just said EPS is not expanding, not predictable. They have a lot of debt to equity and they don't have a lot of cash reserves. So that would justify a pullback in its high PE ratio to somewhere relative to its TTM, relative to its trailing 12-month PE ratio. Given that it missed EPS, I think it should sit below its 12-month trailing average for PE ratio. So let's take a look at that. And is that true here? I haven't looked at it in great depth today. But yeah, that makes sense, right? So PE ratio today is down at 19.1. That honestly seems fair. I wouldn't be surprised actually that it continues to drop lower, because if you look at its debt, its inability to grow earnings, and its current cash amount, this, even at 19.19, when you have other peers trading well below 19, IBM does seem like a little bit of an expensive stock. There may be room for growth. I mean, some people may view that PE ratio as fair. They do pay a dividend, so maybe some people will want to bet on the other side that there's some value in this company, but right now I'm not very favorable. So let's look at what the analysts say. And so this is interesting, and I think kind of aligns with my thought where it's not a strong consensus buy, but it's got some mixed feelings about it, right? So BofA calls it a buy, Morningstar calls it a sell, and CFRA calls it a buy. So IBM is kind of a mixed bag right now. Not really a strong performer, not really maybe not super weak, but also not super strong. So with those 6 metrics that I went over, I think you can start to look at the fundamentals of a company and ask the real basic questions. Is there value in this company? I hope this video demystifies a little bit about fundamental investing, and I hope you can really use these tools to really grow your portfolio. I wish you the best of luck. Please like and subscribe, and I will catch you on the next one. Thanks so much.